Hello and welcome to Strategy Desk. I'm Nandana Veerasinghe and this is our very first episode. Every week on this channel, I'll take one Sri Lankan listed company or a state-owned enterprise and read its latest annual report the way an analyst does, not for the headline numbers, but for the strategy underneath them. If that sounds useful to you, do hit subscribe so next week's company doesn't pass you by. And if you know someone who would enjoy this, an investor, a student, person who keenly follows boardroom action, please share this with them. That helps this new show more than you'd think. For episode 1, we are starting with a big one, Hemas Holdings. Let's get into it. A cyclone tears across all 25 districts of a country. Months later, a war 8,000 kilometers away sends fuel prices spiking, and in the middle of both, a Sri Lankan conglomerate posts the strongest quarter in its 77-year history. Yes, and that's Hemas Holdings' year, record group earnings of 8.92 billion. Today, we find out whether that's good luck or good strategy, and there's proper method for telling the difference. Before we dive in, we are not just reading this report cover to cover. We are using a specific method set out by Ranasinghe and Dhanansurya in their 2023 piece on reading annual reports strategically. It says, don't just trust the strategy section. Test whether it actually resonates through every other part of the document. So we'll start where they say to start, their chairman's and CEO's statements and the about section. Then work through the strategy and business model sections, the MD and A, governance, risk, and finally check whether the numbers back up the story. This is the same method we'll bring back every week. Let's get on to it. The framework says start with the chairman's and CEO's statements. They are the beacons of insight because they combine the numbers with the narrative. And this year, both statements are unusually loaded because both roles change hands. A new chairman succeeded Hussein Yusuf Ali, who served over 4 decades, including as Group CEO. Ashish Chandra became Group CEO in July 2025, bringing 27 years of experience, including cross-border M&A. And the About section gives us a vision and values layer. Hemas doesn't publish a classic mission statement. Everything instead ladders up to one purpose, enriching lives. 4 values sit under it: passion for customers, obsession for performance, driven by innovation, concern for people. What's worth noting already before we even reach the strategy section is that both statements point the same direction: international growth, disciplined capital allocation, digital transformation. That's an early signal of alignment, which is exactly what this framework asks us to test for. Hemas has a genuinely dedicated group strategy section, which the framework treats as the anchor document. It describes a self-reinforcing growth model. A balanced portfolio captures consumption-led demand, scale and market leadership let them upsell beyond pure market share. That funds premiumization and innovation, and a 77-year distribution network gets it all to market fast. Cross-checking against the business model section, the creating value pages, the resources line up with that story. Over 80 brands, 10 plus manufacturing facilities, including one of the country's largest pharmaceutical manufacturers, and 350 million rupee in research and development. So the strategy narrative and the resource base are telling the same story. That's the first alignment check passed. The MD&A is where the framework says you can pin down the generic strategy: cost leadership, differentiation, or focus. Hemas is squarely focused differentiation. Beauty is explicitly called their strategic growth priority in home and personal care, growing volumes at 12.2%. In healthcare, Morrison's Premium Point is introducing novel therapies globally to Sri Lanka at accessible prices. That's differentiation with a value angle, not a low-cost play. The MD&A also surfaces the diversification story, mapped onto Unsoft's metric: market penetration in Sri Lankan home and personal care volumes, product development in novel pharmaceuticals and new Atlas toy lines, and market development into Bangladesh and the proposed Kenya entry. All 4 Unsoft quadrants are active, but each sits with a different business unit. That's deliberate, not scattershot. And underneath, you can see the functional strategies. Thompson's framework calls for R&D driving product design, the distribution network as supply chain strategy, brand investment as a marketing strategy, and heavy ERP and AI spend as the IT strategy, all feeding the same differentiation position. This is the step the framework insists on, and that's a lot of readers skip. Does the strategy narrative actually resonate through the rest of the report? The group strategy section talks about talent development as a competitiveness pillar. Human capital data shows training hours up 46% to 14.2 hours per employee. That's real and consistent. But alignment testing means flagging inconsistencies too, not just confirmations. Attrition sits at 27.4%, an improvement on last year, but still high for a company claiming its people are a cornerstone of long-term competitiveness. That's a place where the narrative runs slightly ahead of the number, and it's worth watching in next year's report. On the segment side, though, consumer healthcare and mobility each independently describe premiumization and innovation moves in their own sector reviews. So the corporate strategy really does cascade down to business unit level. These moves map directly onto the efforts to expand geographic coverage and partnerships and alliances. Levers in the business strategy framework. Kenya is entered specifically as East Africa's commercial gateway, with the explicit intent to broaden into other consumer categories. Once that beachhead is established, stage internationalization, not a one-shot bet. And timing discipline shows in Bangladesh. Hemas let that business build distribution and brand trust before pushing for profit. It moved from break even in year 2025 to profitable in year 2026 with value added hair oil market share climbing from 16 to nearly 18%. That patience is now being backed with more than 100 million US dollars earmarked for the next 4 years of growth. The framework treats governance as more than a compliance checkbox. It wants to know whether the board is actually involved in shaping strategy, not just approving it after the fact. Hemas lays out a 5 tier structure. The group board sets overall direction and approves the long range plan. An investment committee applies a 17% weighted average cost of capital hurdle rate to every major investment. Cluster boards run sector specific strategy, and the CEO led board of management owns execution. That's a genuinely deep involvement. Capital doesn't move without clearing a defined return hurdle and a strategic fit test. It also tells us where incentive and remuneration alignment likely sits, which the framework flags as a transparency marker international reports increasingly disclose. The framework asks whether the risk section actually identifies threat to strategy execution, not generic boilerplate. Here it clearly does. Cyclone Ditwa caused an estimated 4.1 billion US dollars in direct damage across all 25 districts, and the Middle East conflict disrupted the Strait of Hormuz, a corridor for roughly a fifth of global fuel supply. Both risks hit specific strategic initiatives directly. The cyclone tested operational resilience, and the fuel shock hit Forbes Air Services in mobility through supply chain disruption. That specificity is exactly what this step of the framework is looking for. This is a step that separates a credible report from a purely promotional one. Does a company back its claims with numbers? Hemas mostly does. The beauty priority claim is backed by a 12.2% volume increase. The Bangladesh strategy claim is backed by the share and profitability numbers we just covered. Where the evidence is thinner is like the talent pipeline claim against a 27.4% attrition rate. We flagged it rather than take the narrative at face value. That's the discipline this framework is built for. Checking the concern for people value against actual conduct. Water intensity is down 33% from the base year against a 2030 target of 50. Renewable energy sits at 7% of electricity use, and social programs reach over 143,000 people. That's more than a marketing layer. It's tracked against dated targets. What we would still want to see, per the framework's points above narrative audits, is independent assurance over these specific numbers, not just the sustainability disclosures as a whole. worth checking the assurance statement's exact scope. Hemas doesn't bury this in one section. Stakeholder value creation. Value delivered to consumers, principals, communities, shareholders, employees, business partners, and government is laid out stakeholder by stakeholder in the business model pages. That dispersed but deliberate placement is exactly the pattern the framework describes as common practice. The CEO's review closes by pointing forward rather than backward. That's a future outlook step. There's a long range plan being finalized around an year 30 vision, anchored on two priorities: internationalization, lifting international revenue from 3 to a targeted 10% after a planned year 2027 acquisition, and growth through adjacencies like ship spare logistics and outer harbor services. Quantified targets, not just ambition. Now, does the balance sheet actually support the strategy we've just described? Revenue 127.4 billion, up 8%. Gross margin expanded from 31.4 to 32.5%. Stronger commercial execution. EBITDA margin compressed slightly from 13.3 to 12.9 because management explicitly reinvested that margin gain into manpower, digital infrastructure, and hospital capacity. That's a strategy implementation test again, this time on the balance sheet. Gearing fell to 11.5% from 22.4% 2 years ago. Debt to EBITDA sits under half a turn. Interest cover jumped to 13.8 times from 3.7. Net debt has flipped to a net cash position of over 10 billion rupees. Return on capital employed above 32%. Return on equity at 17.2%. This is a company self-funding an aggressive four-sector growth agenda almost entirely from its own cash generation, which is exactly what gives the boardroom to commit over $100 million to Kenya and beyond without straining the balance sheet. One number matters most to shareholders specifically. What did they actually get paid for taking the risk? Earnings per share reached rupees 2.98 this year, up from rupees 2.70 last year and rupees 2.05 2 years ago, accelerating, not just growing. Dividend per share for year 26 works out to rupees 0.95 on a split adjusted basis, with the payout ratio rising to 31.8% from 23% 2 years ago. The board sharing more of the upside while dividend cover still sits at a comfortable 3.1 times. But look past the headline, share price of rupees 29.60. Hemas carried out a 145 share split in April 2025. So that number isn't comparable to last year's 120 rupees sticker price. Adjusted for the split, the share price actually rose from around rupees 24 to rupees 29.60, about 23% capital appreciation. And market capitalization climbed from rupees 48 billion 2 years ago to 88.7 billion today. Add in the dividend, and shareholders earn an estimated total return of roughly 26% for the year. That's a payoff of the growth engine we walked through today, funded from the balance sheet, not from the shareholders' pockets. Please note that this information should not be taken as share investment advice. Running the whole report through this strategic lens, the picture holds together. A purpose anchored strategy, resources that genuinely back it, governance that funds it with discipline, and a balance sheet strong enough to execute it. The one open question for the framework's integrity point is how much of the narrative beyond sustainability carries independent assurance. The real test is the next 4 years, Kenya, the war chest, and whether margins recover once this investment cycle matures. And that concludes episode 1 of Strategy Desk. If you'd like a different company or a SOE put through the same lens each week, subscribe so you don't miss it and share this with someone who'd get value from it. Have a fruitful financial week ahead.